The broadcast is now starting. All attendees are in listen-only mode.
Good evening. Welcome, members and guests, to our first meeting of the International Model Stock Investment Club of 2021. It's wishing everyone a happy new year, and I trust everyone is staying safe and socially distancing. We've been socially distancing since 2016 because we only meet online. Our club, um, our club is a better investing model club open to the public. All our meetings are held typically on the third Monday of each month at this time, 5:30 Pacific, 8:30 Eastern, and the exception being December, when we meet on the second Monday of the month. All our meetings and stock studies are always held online, allowing us to have members from around the world. Our current members are from the United States, Canada, and China. Guests, today you'll be attending as observers, so you'll be muted during the meeting, but we'll have an opportunity to ask questions and give us any comments or feedback at the end of this meeting. Just want to mention that any companies that we talk about today are for educational purposes only and are not intended to be a recommendation for buying or selling any stocks. We ask that you conduct your own review and analysis of any company of interest before making an investment decision. And we may mention some products, services, websites that are not necessarily endorsed by Better Investing or the club. And the views expressed are those of our members, and again, don't necessarily represent those of Better Investing. We are recording this meeting and we'll be posting it to our YouTube channel and for future use. Today, our agenda, we'll start with a treasurer's report, and then we're fortunate to have with us Mike Torbeson. Mike is well known in the Better Investing community. He's given a lot of seminars and education topics on both using the SSG and portfolio management. And today he'll be talking to us about portfolio management in particular. We also have 3 stock studies in the biotechnology healthcare sector, and we have 2 new prospective members that'll be presenting 2 companies, along with Jane Chen, one of our senior members and longtime member of this club. Then you can see down the agenda, next meeting in February, we have a number of quarterly and annual reports, so we will not be doing a education topic. At the end of the meeting, we'll be voting on possible buys or sells. And so with that, I'm going to pass it to Tom Jones for the treasurer's report. Tom?
Okay, I don't think I have the screen.
Okay, let me make you a presenter.
Okay, can you all see my screen now?
Yes, I can.
Okay. Well, let's see here. I don't know quite. Well, I don't know quite how to get this thing. I had it minimized before.
Yeah, it's good like that. You can.
That looks good, Tom.
Okay. So this is the treasurer's report. It's going to be very short, so we have more time for the education or the portfolio review section. So these are our current holdings. Just the only difference is from last month is that at the end of the meeting last month, we decided to purchase $2,000 more of IIPR, so that makes it our largest holding. And So we have two positions that are losers so far, Franco-Nevada and Kirkland. Everything else we're in the black. This is the relative performance. This is the total return of the stocks sorted by the last month. CyberArk and Qualys are leading the pack, no doubt due to the hack on the whatever it is, Cloud Force or CloudStrike, or I don't know. Anyway, this big software hack. So cybersecurity has been hot lately. Over the last 3 months, thinking on the vaccine news, several of our stocks are up, so here with Disney up almost 35%, Schwab up 50%, which is, that's pretty good performance for such a short time period. This is our size diversification, small and micro, we have 19.9%. Mid, we've got 18.7%, and large and mega is 31.2%, and cash is around 30%. And these are the figures in green are what I believe the better investing guidelines are. They recommend 25 small, 50% mid cap, and 25% large stocks. And these are the amounts, the percentage holdings we have in various sectors. Communications is our largest, followed by technology. And this is sorted by 1 year return of the various sectors. And that's all I'm going to present. We'll move on to Mike. Unless there are any questions.
No, I guess not. Okay.
Okay.
So
I had a quick question.
yeah.
Wasn't IIPR our largest holding in one slide, but then it said 9.9 in the last slide? Did I misunderstand that?
Well, that's it's our largest individual stock. This is the allocation to that sector. We have like more than one stock. We've got 3 stocks in communications, and we've got 2 or 3 stocks in technology.
Gotcha.
That's why
got it. Okay. All right.
the sector allocations are what they are. But all by itself, this IIPR makes up almost 10% of the portfolio.
Okay. Thank you.
Sounds like it's my turn. Can everybody hear me okay? This is Mike.
Yes.
I can.
Yep.
Very good. All right. A week or so ago, we did or completed a portfolio review I did with Tom and Tom. And this is the results at the time. And portfolio review is like anything you're managing. You have goals, you measure against those goals, and then make decisions to try to improve the current situation to achieve your goals. So I'm hoping everyone has read about portfolio management in the book, but basically what we're looking at are 4 sections where we have...
Sorry, Mike, sorry to interrupt. Would it be all right if we posted the book in the for guests?
Not at all. It's free to distribute.
Okay.
So we have four basic areas to this review, 3 of which are aimed directly at identifying opportunities for improving the portfolio. So buying and selling stocks can be categorized in one single thing, and that is every buy and every sell needs to improve the portfolio. And so that's what this is all about. Our first area is diversification, which, by the way, looks great. So the goals you can see outlined here. If you have any one area in your portfolio that is, shall we say, a little out of balance, the area that is most noticeable, frankly, is your cash. Now, I noticed your when he just did the treasurer's report, you're a little better under small, medium, and large. But I want to focus on the cash. Basically, you have 20, or actually, I think it's up to 30% cash right now, which means that for every dollar or for every percent that you grow, frankly, you're only getting 2/3 of that, because 30% of it is tied up in zero growth asset. So that's the one thing that kind of sticks out. Amongst these, we see some opportunities, and based on what we had at the time, we would ideally like to increase the mid cap and potentially decrease the small, or I should say small size, not cap. That would improve your rate of growth, which is measured currently, or like I say, last week, at an estimated growth rate of only 7%. Pretty certain that's not in alignment with what you'd like to do, although I got to admit, if we look on, you will see that it's pretty good. Now, that's growth of earnings is really what we're looking at. The goal there is to have about 10%. In terms of sector diversification, you look fabulous. We generally don't want more than 1/3 in any one category. You're nudging up against that in the communications section, but nothing egregious there at all. And when it comes to stocks, you have about 15. We want 15 to 25. And you want no more than 20% in any one stock, as outlined in the goals. So like I say, you're in pretty good shape. Ideally, as we look for something to improve the portfolio, we're looking for something ideally that might increase the mid-cap category and decrease the large size. So potentially we sell something in the large and buy something in the medium. Now, don't get me wrong, there is no absolutes about this. All of these are simply directions we would like to lean, because these directions all lean directly toward improving your portfolio. And we would like to have stocks that have an estimated earnings growth rate bigger than 6.9%. We're looking for something around 10. And then the final thing, as I mentioned, is probably the most important, is that we need to convert this cash into positions. Now, of the positions you have, because of COVID for most of this, you have a number of positions that are not meeting your own estimated growth rates. As a consequence, what would be asked would be to have each of the stock watchers to validate the quality of each of those companies. You know, do they continue to be a quality company that we would like to have in our portfolio? So I won't belabor that. That could take a long time to do that. Generally, once you've, those kinds of things happen around earnings reports is where you really validate that. So I'm going to jump all the way down to your performance. This is the history and the potential of your existing portfolio. Now, of the stock you sold, in other words, this is realized gains, you're probably familiar with the rule of 5. Basically, it says 20% of your stocks may go awry or not perform as expected. And you guys are getting a full 80% out of the realized gain. Outstanding. 80% or better, what you're looking for. We would like to have a portfolio that has a potential future growth of 15% or better. We're low there, which is in fact reflective of the stocks we're buying. So your aggregate estimated growth rate is only, call it 7%. Turns out that it tends to be reflected down here also, showing that we've got a potential growth of 7 versus 15. Now, I can tell you right now, the other thing that's most reflective of that is the cash. Whatever your real growth rate is, a third off of that. You've just hobbled yourself with all that cash in terms of growing the portfolio. Now, the good news, your combined real and unreal performance is frankly quite nice. You've got, you don't quite have 5 years of history yet, but for the last 3 years, you've done about 18% compared to the market 16%. You've done about the same thing for the last year. The market, however, is bumped up a little bit more, but 17, 18% is nothing to, thumb your nose at. Very good. So what these numbers tell me, when we see this kind of difference between your potential and your report card, how well you're doing against the market, it says very clearly you can pick good stocks. Our whole objective is to pick quality stocks. Again, we've got a group up here that we're being asked to verify, are they still quality stocks? Almost all of these are down because of the COVID dip. Generally, that provides buy opportunities. So if we take your existing portfolio, your SSGs, put them into the PERT, and then ask ourselves which ones have a potential return better than what your portfolio is currently getting. Well, now there's a little problem. Our minimum that we want to grow is 10%. You're at 6.8, so we're going to set our target at better than 10%. And so we've got a few stocks that will in fact improve your potential return if purchased. We've got 2 of those that actually show themselves to be in an excellent buy position. However, only, 2 of them show themselves to have appropriate risk. Now there's an asterisk by the Facebook because the peg was a little out of whack, but we wanted to have something in here for this presentation, so we left it there. So what fits all of that in terms of what can improve your return, your reward, and what has acceptable risk? Facebook can do both. So it's basically, it passes all of those questions about, can it improve my portfolio's reward? Can it improve my portfolio's risk? On the downside, how many stocks are earning less than what the market is? The market historically does 10%. Last few years, it's actually done, as you can see, 15 to 20%. So your potential on the rest of these stocks, frankly, is abysmal right now. And so the first question is are there any stocks that we could sell and improve the potential return? Turns out quite a few. How many of those actually have a PE, and we're going to talk about that in a minute, that shows it to be in a sell position? Well, turns out most of them the way we currently have the SSGs filled out. And how many of them have unacceptable risk? And again, the SSG with its current judgment suggests that all of those stocks have unacceptable risk. So that brings us down to quite a lengthy list of stocks that, if sold, would improve our portfolio return and would improve our portfolio risk. So with that thought in mind, we basically take a look at each of these sections and look at these opportunities we have to improve our portfolio and attempt to consolidate those. And it kind of boils down to a couple areas. Find mid-sized companies on the watch list and add them to the portfolio with 0 shares. So one of the things that you don't have in your portfolio for evaluation right now is a set of watch list stocks, a set of quality stocks. And so one of the things I'll encourage you to do is simply add half a dozen stocks to your portfolio, no shares, but they get voted onto the portfolio because quality companies. And you can pick quality companies. You've proven that. Then the other side is to consider buying something that actually improves your portfolio. Facebook, in this example, happens to do that, and that you actually do have a few companies that have achieved their higher price targets already. And so something you might want to look at in potential sells depending on where they are. So that's what your portfolio review tells me. Let me ask at this point if there are any questions.
Mike, it's Hanny, Michael.
In our
we
portfolio.
Sorry. Okay.
Oh,
Bernard, go ahead, Bernard.
Just one little question here. Oh, thanks, Haney. So, but if we look at the portfolio right now, it's hard to tell for sure. Is the company bad, or is it just the coronavirus that has put so many of these companies in a bad way? To separate a good company and or is it a bad company, or is it coronavirus? It's kind of confusing right at this point, as I see it.
Well, no, absolutely.
Thanks.
It can be very confusing. And, one of the things that you will discover after, I've been doing this since late 80s, is there are certain companies that you come to know better than others because you've studied them over and over and over again. And if you go through the SSG, you will see on most of these companies that yes, they are currently missing their estimated growth rates. But looking at that 10-year pattern, all we see is a downturn in the recent time frame. So the real question, and this is a skill that it just doesn't happen overnight. The real question is the company at risk of missing its strategic growth plan? And if so, why? Now, in the case of for 1 or 2 years here, the answer for many of these is going to be, my goodness, yes, they're likely to miss their strategic growth plan as announced, particularly pre-COVID. Then if that's the case, then the crux of the question is this a temporary problem, or is this a systemic problem? Well, COVID is clearly a temporary problem. So as long as they continue to execute, they continue to work on the same strategic growth plan. In other words, they're selling the same kind of products, they have the same management, et cetera, then we can be fairly confident that as things come out of COVID, these companies are going to recover. So that's always kind of the catch-22. When it drops, is this a buy opportunity, or am I looking at a falling sword? And I would be willing to bet in most of these circumstances, I'm familiar with many of these companies, not all of them, you're looking at, what were absolutely fabulous buy opportunities. Now, admittedly, you can only make one or two, take advantage of it, one or two, just because that's the amount of cash you have, et cetera. But I think that if your stock watcher comes back and says, hey, this company is down because of COVID, and we know COVID is going away, and we see no other systemic issues that they're going to go out of business, then generally speaking, we want to be able to buy more. And which ones do we buy? Well, that's the second part. After looking at your SSGs, one of the things Tom told me, I guess that covers both, is that you try to take conservative approach. Okay, that works. But where you really went a little overboard was your PEs. What's not really obvious about PEs is that they define where our potential entry and exit points are. Everybody in here knows you want to buy low, sell high. But what's not obvious is that you want to buy low on the PE. Prices continue to change and go up while the PEs stay fairly stagnant. So just like the tides, every company goes through a business cycle. Some take longer than others. Some have very narrow troughs. Some have very deep troughs. And like the tide, because of economic situations, etc., COVID, often we have like a low tide. We have like a king tide. I think we're having those in the West Coast right now. And so understanding that our companies do that, one of the pieces that we don't teach well when we talk about an SSG is that up, straight, and parallel is only 1/2 of your requirement. That says it's a good stock to own. That does not say when to buy or when to sell. That's where we try to look at the business cycle. That's what section 3 and 4 of the SSG are all about. And it turns out that we link to a tool, Big Charts, that gives you a superior PE chart for 5 years, much better than you see on the SSG. So here I have a sample. This is CTSH before they really went south. But two things that you really want on a stock that you're going to include in your portfolio. Number one, up, straight, parallel. Number two, reasonably obvious and predictable business cycle as shown in the PE. This identifies where you want to buy and where you want to sell. I want to buy low. I want to sell high. Between up, straight, and parallel, buying low and selling high, it suddenly becomes really obvious where and what and when you buy. Questions?
That was a very enlightening explanation, Mike. Thank you for that. I just want to go back to something you said earlier, which is looking at 15 to 25 stocks in the portfolio, because we've had quite a discussion related to the number of stocks that we should own. And one of the issues that we struggle with is length of meetings, and doing quarterly reviews, annual reviews. As the portfolio gets larger, it becomes more and more difficult to do that in a timely fashion, and at the same time meet requirements for education and so on. So the meetings get a little bit unwieldy, and
Yes.
so I just wanted to get your perspective on that.
Oh, yes. Well, the basic criteria, no, the logic behind 15 to 25 is based on mathematics, and it looks at volatility. So there have been studies done on the market, and what the question that's been asked is how many stocks do I need in my portfolio to at least match, not be excessive, to at least match the market volatility? And the answers turns out to be someplace between 15 and 25. With about 10 stocks in your portfolio, you start to see a notable reduction of volatility. I mean, the most volatile portfolio you can have is a portfolio with one stock. So as we add stocks to that, we start to see a reduction of volatility. Volatility doesn't go to zero, but what it approaches, is market volatility. And so when you hit 10, you actually start seeing that, particularly if you've been managing it from 1 to 10. And from 15 to 25, you see a reasonable change over time. And once you hit about 30, you can add as many as you would like, and you will likely not see any change whatsoever. As some of you probably know, you can actually calculate the beta for a portfolio. And so if you really wanted to do the math around it, you could do something like that. Now, for clubs, particularly for learning clubs, there is another issue that has to be addressed, and I think you alluded to it. I don't have the time to deal with it, and I don't have enough people with enough experience to monitor that many stocks. Well, yeah. So probably the biggest obstacle to getting that many stocks is the number of members in your club, as well as their capability to monitor or track stocks. So that actually becomes, in clubs anyway, kind of the dominant issue. I've only got 10 people, we're all new, and really we're having enough trouble keeping track of one stock each. Great, do one stock each, have 10 in there. Just be aware that the volatility with 10 is going to be more than if it was, say, 15 or even 20. So that's one of the things you do to say, well, I've got 15 in this portfolio. What's another way to improve my portfolio? I could just add one more stock, assuming I've got the head count to manage it. Does that answer your question?
Yes, that's bang on.
But
we did, in fact.
But volatility.
Yeah, sorry, Bernard.
Go ahead, Katie.
Oh, I was just going to say, we did actually do a calculation a while back, measuring the beta for the portfolio, and it was, I think at the time we had about 15 stocks, and it was about close to, as you mentioned, close to the market beta. So.
Okay, good.
So, but volatility is not fatal. I mean, it's not a big deal, really. There's a studies in the American Association of Individual Investors that volatility is very temporary, and usually things, they go down, but at the longest they're back in 3 years. So you can live with volatility.
What you want to do is make it a choice. You don't want to just haphazardly accept what you've got. You want to simply make a choice. If you're willing, I mean, hedge funds that make huge amounts, they generally have no more than 10 stocks, and they normally put 40, 50% of their funds in a single stock. It's a choice, and it's really dependent on your risk profile. So everything I'm saying is aimed at optimizing or balancing your risk against your growth. If you want to have more risk and more, I mean, they go hand in hand. If you feel like you want to make more money, then you can easily increase the risk. Technically speaking, as I suggest, you get stocks that are growing faster than 6.9%. Let's face it, that would be increasing the risk that goes along with a higher growth stock. So all of this is all about a balance. And the most important thing here in my mind is to be aware of what you are willing to accept and to manage to that level. So when I say these are the guidances, these are the general guidances. As a group, you may decide, gee whiz, I would like to have a really high risk, high growth portfolio. In theory, it's your money, it's your choice, but is it an informed choice or is it just risk? Does that answer that?
Hi, Mike. This is John Patterson. Thanks for making a presentation to us. I have a question about this Word document you're on right now, but it's D1A, I believe. I can't see it right now, but you said the 80% there. Can you explain that a little bit further about the 80%? What that means?
Oh, this is a simple one. So this is based on the rule of 5. The rule of 5 basically says that for every 5 stocks for every 5 quality stocks that you go ahead and pull the trigger on, that when you look at what you predict, that one of those stocks is likely to exceed your expectations, one of the stocks is going to be underperforming, and the 3 are going to be meeting or generally meeting your expectations. And so one of the things that I found to be exceedingly useful is actually trying to track your progress against the rule of 5. With 80% of the stock, now the definition here that I'm using is it's a winner if your profit is greater than 0. So it's, you could get real picky and say, is it meeting or exceeding our expectations, which frankly becomes a lot more work to track. But this is real easy to track out of your capital gains report. And so one of the things that this number tells us that we don't talk too much about is that, let's assume my goal is to make 15%. You guys are doing 17 or 18, so clearly you're doing that. But you have to build into that assumption that 20% of the stocks that you sell are going to be losers. So it's not just buying stocks that are going to get you, call it 18%, since that's what you've done. It's also buying stocks maybe that are at 20, 22, 23, 24% potential return to make up the difference that we see with the numbers that we lose. I can almost guarantee you if that winners and losers number gets below 70%, you're not going to like your results. And so monitoring that early on kind of puts some emphasis on the fact that when I sell, this is kind of a Warren Buffett rule, rule number one is don't lose any money.
5 minutes.
Excuse me?
You have 5 more minutes.
I'm done.
Oh, well, you have 5 minutes for questions.
Okay.
Oh, thank you very much, Mike. I just wanted to point out here, Mike said we could download his book, and it looks like it's been posted here. The stock selection and portfolio management. So if anybody wants to download it, you can download it right now.
Oh, and I do have a question for D2A, potential portfolio potential return. That's strictly based on our judgments, right? On our SSGs. Is
Absolutely.
that what that's based on?
Yeah, so that number, the way I looked at your SSPs, I think is lower than it really needs to be. If I go back and if you actually take a look at those PE charts compared to what you put in for PE estimates, I think you'll discover that you overdid the high and the low PE trying to be conservative. So if I had one change that I would do to all of your SSGs, it's reevaluate your high and your low PEs, because that number in section 4 is what actually defines your entry and exit points.
So we need to be get tighter with on our judgments and our estimates.
Yes.
Yeah.
Yes.
Okay.
So don't be afraid of making realistic judgments. What you want to be afraid of is you know, losing money because you didn't buy something. I mean, right now you're not losing anything. With all that cash, it'd be hard to lose. So get more quality stocks in your wish list, add your wish list to your monitor list. And so when you go through this process or any process, you automatically have stocks that you can, and I add that, not necessarily add, because this is not really about buy and hold. The methodology is most effective with buy and replace. Sell a stock with a low potential, and at the same time, take that money and move it into a stock with high potential. Buy and replace.
We
Thank
have
you.
2 minutes.
I do have time.
2 minutes.
I have a question. If we have time.
Okay, I guess I have 2 minutes.
I have a question if we have time. We have minutes.
I have less than 2 minutes now. Go.
Okay, well, yeah, maybe there's not have to answer, but so the stock watcher do we have stock watchers for these zero share companies? Is that the idea, to have them do reports on or at least watch it and make SSGs for themselves to keep us informed, or what?
Well, let me answer this with a simpler approach. Is don't study all of your stocks all of the time. You only need to look at them once a quarter to see if they're meeting your objectives. But when you come down with the list of stocks that will potentially improve your portfolio, that's when you ask the stock watcher to do an update. So in this instance, in this example, which is a little egregious, particularly the sell side, I would ask all of the stock watchers here to validate the fact that, yes, this is an appropriate time to sell the stock. And I would ask, in this case, just Facebook, is this a good time to buy that stock? And so when you come to your reports, take only the time you need to evaluate the stocks that have been identified as potential buys and sells. You'll reduce the time to report significantly.
Yeah, sometimes the timing's not right because I follow Facebook, and a couple times it was a buy, but because of it was our largest holding, or we already met the portfolio size allocation, we chose not to buy.
Yeah, but if it's a buy and you're the watcher, you should at least say it's a good buy time. And then someone will say, well, we've got too much of it. And then that's a choice. That's a
Correct.
conscious
Okay.
choice. Do I
Gotcha.
want
Okay.
to overweight or not?
Mm-hmm.
Thank you
Maybe
very
people also,
much.
maybe members can also add it to their own personal
Yeah.
portfolio.
Amen.
Okay. Thank you. We are going to move on to the stock study. If we appreciate your presentation, it's very informative. John Catterson,
Thank you.
ready to do the overview?
Yeah, I'm ready.
Okay, I'll make you the presenter.
Okay. All right, good evening, everyone. So our club is looking at biotechnology industry, and myself, John Catterson, Adam Darris, Rita Ganta, and Jane Chen are presenting, as well as Joanne really helped out a lot with our study. So this is the disclaimer. Henry, did you read this?
No,
Yes.
actually, Henny already did at the
Yeah.
Oh, you
beginning.
already read it. Great. So you already read that. Great. So that's in there, and you can check that out later if you want to. Guess you can refer back to the recording earlier on. I'm not going to read all that again. Here's our agenda. Why do we pick this industry/companies? I'm going to verbally explain that. Then an industry study for 2 and 3 there. And number 4 will be our stock studies, Regeneron, Vertex, and BioMarin. And here's a little graphic with biotechnology. And then a
John,
couple of
can you
things
make it
here.
full screen?
Okay, I'll try.
Yeah,
I can
go
do
ahead,
that.
just present.
I'll,
Yeah. No, I mean for your slides, just make a full screen slide. Just
Yeah.
hit
Okay.
present.
I think you could
present.
click there kind of in the top quarter there on the right where it says present.
Okay. All right.
Up,
Yeah,
up, there you go.
Yep.
was blocked by the webinar control panel.
Oh,
Okay, so biotechnology industry. There's a couple markets in the biotechnology industry. Agriculture is a big one, but we focus on the medical market. That's probably the biggest. They had $284 billion of revenue in 2020, according to this link. You can click this link if you're a member in the Google Drive. There's also, I believe my notes said there's 725 billion by 2025 is what Joanne found. This is drug discovery using genes and proteins. Typical drug discovery by a pharmaceutical company, a traditional pharmaceutical company would be using chemicals. It's using genes and proteins. Cloning provides an exact copy. This is Dolly the sheep right here. I'm sure most of us remember her from back in the day, and she was a clone. Genetic modification is more common with these drugs. They move specific genes, they change specific genes to target the change that you want, not just clone something. So, okay, I skip this slide. How do I go back? I don't ever use this type of thing. Oh, there we go. Okay. This is also a link up here, identify industry trends. If you want to click that link in the Google Drive, you can check it out. But genetics advancements lead to personalized medicine, represented by this nifty picture here. Since someone knows your genome or knows parts of your genome, they can give you a personalized treatment based on that. Value-based pricing of products just means that just like a lot of other industries, things get cheaper as people compete. As an industry, as the companies compete in the industry. Quickening of the drug approval process, we all saw that with the vaccines. I think there's 3 of them now that are either approved or in process. And so that was quickened because of the necessity of that, but also in other areas as well. Recommended for an investor is to examine the R&D spend over the revenue. So that's the research and development spending divided by the revenue that they generate. It should be obviously not super high, but it should be reasonably high because you want them to be spending money on R&D. It's definitely a good thing that they do that if you're investing in a growth biotechnology company. Recommended to inspect the product pipeline because that will tell you you want stuff that's for sale, stuff that's almost getting to market, and stuff that's being developed. A lot of stuff that's being developed and maybe thrown away because it didn't work out, but being developed. You want a pipeline of products, not just stuff that's for sale or stuff totally in research and so forth.
What's considered
Pipeline
high?
applies to a lot of the. I'm sorry.
Oh, what's considered high for the R&D?
I don't know. Honestly, I don't know the answer to that question, but I would think we'll hopefully we can see that with some of our stocks we picked today. I think they did. I think they did cover that, some of that, the R&D for their companies.
Okay, thanks.
But so the challenges for the industry, a lot of this pertains to the pipelines, because product pipelines are capital intensive, so they require a lot of work, not capital in terms of like steel girders, but capital in terms of research and paying high-paid professionals to research this stuff. Outside cash may be needed if there's not a strong pipeline. You know, if there's not enough revenue like this right here, usually profits for years, I require them to get either issue shares or take on debt. And might be difficult to get an FDA approval. I know I said that it was getting quicker, but it's still a lot of stuff goes through to the FDA and doesn't get approved. I'm sure a lot of stuff is kind of shotgunned out there to the FDA, but and see how far it can get before they go further. But it's sometimes hard to get the percentage FDA approval. It goes faster. But and market volatility is expected. This is one of our stocks for the day for the past 4 or 5 years. The stock price. Not anything to do with the earnings or anything like that, but the stock price. So price volatility. And that's all I have. Next we have Adam with Regeneron.
All right, so am I sharing the screen or do we keep going on this one? Okay.
I make you presenter, Adam.
Thank you.
Mm-hmm.
Let me see if you see my screen now. All right, thank you. Thank you for the opportunity to kind of study and learn something about the SSG and everything in investment. So this is my very first kind of study and pretty interesting stock to kind of present to you. So Regeneron is one of those biotechnology companies that's been around for over 30 years. It's a medium-sized company, so from a sales perspective, so maybe it does check mark the one of the criteria from portfolio review that we should look at it. Discovers and develops drugs in space where diseases like eye disease, cardiovascular disease, cancer, inflammation. Has about 8 products that are already kind of established in market and have about 20 plus pipeline of drugs that they're developed. The company is kind of about 9,000 employees. More than 1,000 of them are PhDs and so on. It's one of those companies that does 100% of drugs invented and developed in-house. So they kind of actually are proud that they are the only large cap biopharma that actually was funded by scientists and runs by scientists. So they're proud of that. The stock, when you look at the historical 10 years, but I focused on the last 5 years, the sales growth was over 18%, earnings even higher, 40%, pre-tax profit 22, return on investment over 20%, and the debt just jumped to 21 this year. It was a single digit last up to the previous year. So what I did here, I look at the club policy as far as how we should select the stock, and based on the guidelines, and try to see if the stock actually checks out all those guidelines. So obviously the very familiar ones, steady and consistently growing. So you will see those parallel lines on SSG, 80% sales growth, which is kind of for the medium company, pretty well even above the range of 12 to 15. Pre-tax profit 32 and ROE trending up. There's a dip in last year, but over the last 10 years it's trending up. So that's why I kind of check it not totally green there. And the debt to capital ratio was 8.5 for many, many years. Now with the COVID investment and so on, it jumped last year to 21. I think guide says that as long as it's below 30, 33, we should be fine. And rest of those things, the PEG, the SSG ratio, all this stuff points out to good, checks out all those marks, including the value line ranking and so on. So let me just share the most recent data. So the biggest one, I guess, is on January 12th. They did get new agreement that covers additional 1.2 million doses of the COVID antibody cocktail. So in a sense, a big deal because last year at the year end, they had about, I would say, 140 million revenue from that emergency approved COVID cocktail. Now, obviously, this additional 1.2 million would generate 2.6 billion for this current year. So that's a big news there. Otherwise, related to that COVID antibody cocktail, they also study as there are new kind of new, I guess, variants of that COVID virus out there. There's so-called UK and South Africa. They are rather certain that the UK one would also be kind of covered and taken care of by their existing cocktail. There are two major drugs that really they have in the market that practically generate the most revenue. One is the ILA, which is for the macular degeneration. And that one, again, has a strong year this year, year over year, over 10% sales. So with about almost 5 billion sales for the 2020. And Dupixent, which is more of a asthma type of drug, that one also is gaining nice market share and actually crossed the 1 billion type of revenue for them. So strong, seems like another strong year for them in 2020. As I mentioned, a significant pipeline of 20 plus products. In my first cut report in appendix, I put some additional information there if someone wants to, there's a link there. But those drugs that actually are getting extra approvals, and interestingly enough, some of the drugs that are existing in the market, they get approvals for some other kind of diseases. So, and in some cases like Dupixent, they get approval for, let's say, pediatrics for younger kind of patients out there. So great story as far as pipeline goes. And if it comes to risk, I think to highlight their most successful drug for the macular degeneration and eye disease, the Eylea, has an expiry of patent depending on the location next 2-3 years. So in a sense, there is a risk, although there are the market kind of drug in that space. The other one is that the COVID, the antibody cocktail, is approved under emergency FDA kind of situation. So there is still phase 3 study that has to be completed and truly approved. So that's a risk as well. And in some cases, when they applied the cocktail, they found that for patients with the high oxygen type of situation, the antibody cocktail does not really help. So they had to withdraw and put those study on hold. But for other cases where you don't have the situation of high flow oxygen, it applies and it works. Other news, they keep repurchasing shares. So they have a buyback program for 1 billion shares. So they are close to being done with that. And as Jan mentioned, that there is a significant investment in R&D, about 40% of the revenue. Okay, so closer to SSG. As I said, the revenue and earnings are growing steadily. If you can see from the trend, actually earnings per share is growing faster. It's a kind of historical trend there, which is unique because you don't expect company to do that for a long time. But in this case it is. And here I'm highlighting that jump in the debt where because of the additional investment for the COVID situation, they really beefed up how much they had to put money into research and get more employees to kind of deal with that. So here is what I forecasted from my perspective. I look at various analyst kind of reports out there. And as you see right in the middle of there on the left side, I capture some of them, what the earnings were forecasted. Average came to about 15%. I did go rather conservative with 9.5, which is more aligned with the value line revenue growth for 23 to 25. And it actually is maybe, if you look at the actual forecast of 1250, I guess 12 billions, 1250 millions out there, my forecast comes to slightly more, 12,379. So I would say I'm kind of conservative, but a bit optimistic, even with respect to value line. The earnings per share, my forecast is consistent with their historical kind of tiny, better than revenue kind of trend growth. So my forecast was 10. It still came, it's lower than the average forecast I had from most of the analysts. I would say still conservative in this case, but pretty much aligned with the value line, which was about 34 in next 5 years. Mine is around 35 if you're looking at 5 years estimate of earnings itself. Further, as far as earnings per, like average high PE, I went with 27. So what I did here, I look at kind of outliers with more or less established company. I didn't want to go for values that are very high, above 40. In some cases, one would argue that even 30 probably for established companies is kind of high ceiling, but I decided to kind of scratch anything above 40, which brought my average to high PE to 27, and that's what I used. Given that 27 PE, I calculated the high price to be about 957. Kind of gut check with value line. They had a high about 1020, so not too far, not too bad. I would think conservative, but not too bad. The low price, I didn't go for low P directly. I went for low price itself, and I look at 52 weeks low price was pretty 328, pretty low. I decided to go with the downside risk of about 20%, which brought me down to 414. With that 414, my I guess buy range came to the close price, close up being 517. Yeah, the 20% down came to 414, which practically created the downside ratio of 4.2, which is still considered good for investment. And I guess that's where I was looking for the range between the buy zone was about 414 to 550, and with current price being 517, I end up still in the buy zone. So it is a mid-sized company, so it checks the aspect of where our portfolio is missing some of the stocks investment. I guess the return of high average P of 8.6 is a bit higher than the 6.9 that we're averaging in the portfolio, so it's also a good story there. If you look at the high P return would be about 30%, but I guess to get that 15% over the next 5 years, we would have to buy it at 475, which right now at 517, it's kind of higher than that. Still, I think it's if not buy, it's at least put it on the zero share watch list because it has a great potential. I would think that with the latest news of the extra 2.6 billion revenue coming from that COVID antibody cocktails, I think those numbers will actually start looking better, at least for this year. Provided that, that cocktail will be something leveraged down the road. Who knows how the COVID works? If it works like flu, that every year you need to get something, maybe that's going to be ongoing revenue as well. This is the risk I'm highlighting is really the expiry of the patent for their major drug that they have, and obviously the final approval of the COVID antibody. Just for your educational sake, this is how the antibody kind of situation works. So as you have the virus kind of thing, it will try to bind to your healthy cell, and the antibody provides those interesting proteins that they bind to the COVID virus and prevent it from practically attacking the healthy cell. So that's kind of extra educational aspect of what this is all about. Any questions? Because I think that's my last slide.
That was a very good presentation.
Price went up.
It went up from 517.
Yeah.
All right. So I guess I think the good news
well,
about the COVID antibodies is really pushing them up now.
I would just want to comment here. It's interesting that they're buying back shares and their debt is increasing. That's not encouraging.
Yeah, I think they're completing their buyback share program, and the increase in debt was really very related to that COVID antibody development, as they needed to expedite it and kind of put it on the market as fast as possible.
It seems to me they would stop the share buybacks and put that money into R&D rather than borrowing money.
Could be.
Hey,
Also,
Tom, are
just
you
with
familiar
the
with this company? Sorry, Annie.
Pardon?
Tom Jones. Are you familiar with this company
Well,
as a pharmacist?
I looked at it a little bit. You know, I'm not super familiar with it. You know, I'm concerned about the ILEA. I think, you know, that has competition. And you know, I think that's their biggest revenue source. And you know, the pipeline things are really hard to figure out. You just never know what's going to be approved. You know, I looked at one. I think they've got one that's going to come on the market fairly soon. And from what I saw on that, it's only it targets a gene mutation that's like 1 in a million people. And that would, in the U.S., that would only be like 325 people if you had 100% penetration. Now I know they, you know, it was interesting. They talked about value pricing, but you know that you know they sell this stuff for huge amounts of money. I guess their antibody they aren't selling for quite that much, but I think that's the antibody is going to have limited usefulness as the vaccine rolls out, if it's as effective as advertised.
I
So
studied this company about 5 years ago when I looking at a Biogen as a competitor. I don't remember. I did not buy this one. I don't remember why. So everybody, if you want to know, ask Tom because he's a pharmacist. I want to know if he's familiar in this industry. As my doctor, medical doctor, he does not own any healthcare biotech. The reason why he said because it takes so long, you know, the trials, all that. It's rewarding could be big, but the risk can also be high. So that's why, Tom, I'm asking you if you invest in your portfolio like a pharmaceutical biotech is a bit more than anything else, since you work for this industry. You work in this industry.
Remember how long we waited for the aducanumab approval on Biogen, and it's still not approved.
Yeah, right.
So
Okay.
it's a crap. This industry, you know, it's a crapshoot.
But at the same time, it's getting to a point with the COVID situation that it brought this industry to forefront, right? So yeah, I think it's an interesting question someone put out there, and I think it's our next presenter, is that if the vaccine really is there and works, would they still use antibody cocktail or in what situation? Is it only for people who don't want to be vaccinated, or is it something that people would take preventively anyway? I don't really have a good answer for it, but I guess it's more of a medical kind of scenario.
And also, don't companies buy back shares for many different reasons? It's not necessarily, you know.
Yeah, I think in their case, it's simply the running to tail end of that program that they had. It was, you know, they decided to buy like 1 billion and there are 370 left. So it's an ongoing multi-year program that they had, and I guess they could have redirected it or but at the same time they probably got a good financing with low interest rate nowadays.
One question about that related to the share buyback. Do you know at what price they were buying their shares at? Because that makes a big difference if they're just like us, if they're buying high or or buying low, it makes a difference in the long run.
Yeah, I can't tell, but if you saw the graph was pretty choppy over last year or years, so they had a low. I don't know. I would have to look back into 10K and see what they said there.
Okay. If there are no other questions, we'll move on to the next presentation. Thank you very much, Adam. That was quite good.
Thank you.
Thank you.
Ready? Are you ready to present?
He's
Actually,
muted. I can make.
I don't think he has
Uh-oh.
his.
Do we? Oh.
He's using his cell phone for the audio.
Ready is self-muted.
Ready? Can you unmute yourself?
Yeah. Okay.
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 All right. I'm going to make you the presenter. Ready?
Okay. Okay. Thank you.
Ready? You have echo. So you want to? Do you have both cell phone and computer on?
I turn off the computer.
Okay, you got an echo going on
Your
right
computer.
there. The speaker.
Yeah, your computer is.
Okay. Computer came back on. Okay.
Yeah, turn
I
your.
turned it.
Turn
Just
the.
mute one of them. Mute one of them.
Okay.
Go ahead. Yeah, you need to mute. Do you want? Yeah, go ahead. Can you mute your phone instead? Mute your cell phone. Okay. Oh, so he doesn't have. Oh, he doesn't have microphone for his. That's weird. If he doesn't have microphone, how come there's echo going on? Oh yeah, you need to mute other way around.
Which one we should keep on?
You are good. Okay.
Now you're good.
Now it's good. Okay.
Yeah, but
You're good.
I can hardly hear you now.
You don't need to hear us. Just give the presentation.
Okay. Is it good now?
Yes.
Yeah.
Okay. I will turn off the cell phone.
Okay.
Okay. Okay. My presentation is on another biotech company called Vertex Pharmaceuticals. This is a picture I got it from the disease on cystic fibrosis. Basically, it's affects the lungs and collects the fluids, and it's a deadly disease. Patients eventually die. Vertex company is a global company. It's a mid cap, $60 billion market cap. Its main business is in healthcare, biotechnology. It is one of the S&P 500 index company, and it is voted as the top industry to work for. The main mission of this industry is to discover and research, develop, discover and manufacture, and commercialize the disease drugs for rare diseases. And right now, this is the world leading company on what is called cystic fibrosis. There is no competition so far. It can cure about 90% of the eligible population all over the world for cystic fibrosis. It's basically a small molecule drug developed by this company, and they have complete control of it because it was all in-house research. Specific niche in healthcare market worldwide in this drug. What is cystic fibrosis? Cystic fibrosis is a progressively deadly disease that basically attacks the lungs and decreases the lungs function. Total population in the world is estimated to be about 75,000 people suffering from cystic fibrosis. They need a lifelong treatment once they get it. And Vertex can treat almost 90% of the eligible patients. It has major 4 drugs. The first 3 are well established, and the last one is approved about a year ago. The first 3 attack kind of a subcategory of cystic fibrosis. The last one can cure all these 3 different symptoms, and it is just coming into the market, and that will catch up and it will make good money. Its Vertex drugs have strong efficacy and lengthy patents because it's all in-house research and very difficult to for anybody to come up with the generics. Its patents are long and estimated to be at least 10 years effective. And they have all these drugs are very highly profitable now. And this is going on for many years, but these drugs are disease modifying. But the latest technology is genetic mutation or gene editing. But the Vertex is not sitting there. It is now current research is going into gene modifying drugs also for cystic fibrosis as well as several other rare diseases shown in the next slide. What are the other drugs? It's diversifying quite a bit. It's doing research on several other rare diseases called sickle cell, blood disorder, rare blood disorder, antitrypsin deficiency, kidney disease, muscular dystrophy, diabetes, and cell genetics. And now also it's a first time it is going out and collaborating with other companies for research, and there are high potential for several drugs to be coming into the market in the near future. What are all these? This is a pictorial view. I think I found it on the company website. This major one is cystic fibrosis. These are all the pictorial representation of different rare diseases that Vertex is now working on. In general, the one thing I noticed especially about this company is they spend 70% of their operating expenses on the research, ongoing research and future research in the drugs. Total, for example, they spent over, I think, 1.3 billion per year last year, and it continuously increasing. Another feature is these are high-priced drugs, and hence because they are high-priced drugs, there are reimbursement challenges, but company has overcome those challenges in Europe, and now very steady income from these cystic fibrosis drugs. It also acquired 2 private biotechnology companies a year ago, and their companies are Exonics and Semma Therapeutics. These are doing cell research on diabetics. The collaboration, what are the collaborations it has now currently ongoing? It is diversifying the research, collaborating with CRISPR Therapeutics on gene editing, and the European Medicine Agency already had designated 1 drug from combined research on sickle cell disease. The positive clinical tests are coming out. The another collaboration is with Moderna, and you probably heard of Moderna, gene editing drug for cystic fibrosis. The another company is Taika Therapeutics for treatment of other serious diseases. It has its franchise well positioned, long-term growth potential, and it it has ability to blockbuster outside CF with all these current research. These are the companies it is collaborating, like CRISPR I mentioned, Moderna I mentioned, the number of companies it's working on because it's diversifying its business. This is the graph, the stock chart. I just wanted to show here a couple things. One, there is a drop here, price in October last year because one of the two drugs that they are researching, they dropped it and the market reacted. So from market reacted, it's coming back up. I think this is a good time to buy. I have more reasons in the upcoming slides. It crossed the 50-day moving average, and relative strength is 44. Convergence divergence index is positive now. SSG, okay, SSG here I plotted. In addition to, there is a feature in the SSG to plot your own future assumptions. The blue dot is from value line. This green dot is also from value line. My projections are the conservative, and and also I suppressed all these because in earlier years it was cash burning mode, and these plots are on logarithm scales. They don't make sense. So last 3 or 4 years, its profits are steady and increasing. And in fact, if you go the extrapolate this, profit is around 90%. I assumed the revenue to be 17% and earnings to be about 25%. It's anywhere between 25 to 30% revenue, and my projection coincides with value line 5 years from now. That's the basis. Next slide is, yes.
Sorry, interrupted for a second. Can you also present the slide to make a full screen on the slide? Could it present on top right? Go up. Yeah, there you go. Yeah. Oh, thank you.
Okay.
Now I can
Okay.
see.
Yeah. So one thing, when you see these negative numbers, it's better to cross them out so you can realistic the line through the data. And if you extrapolate this will be near 100%. But there are a couple of reasons why we have to be conservative on this one, because current drugs are disease modifying. New drugs research is going on in genetic modification, genetic editing. Second thing is, of course, it's expected that about 10 years they will have patents, and it's impossible to get a generics, but we have to, they are spending considerable amount of money on other rare diseases, and hence this conservative assumption, and this is realistic assumption. It coincides with the value line. By the way, the SSG uses Morningstar data, but we have to look at the value line with the adjustments, one-time adjustments, and use the data. I'll show you in the next slide. Then another question that could come up with is, why can't we use preferred procedure? Biotech companies are not typical for a SSG with a long range records where, okay, straight and up, you don't get that many times in the value line for biotechs. So if you do the preferred calculation procedure, we have to guess that. For less expenses, expense cannot be negative, and they can spend a lot of money for future R&D. So we have to guess all these numbers. Instead, we look at the value line and look at other analysts and projections and make a judgment, and conservative judgment. Next is, if you can see this P ratios, high and low, they have no meaning, and especially 2017 or so, they started making profit, and these are erratic. So I deleted all these high values, and now it's about stabilizing. You can see 50, 35 companies stabilizing, products are established now all over the world. So any established company PE ratios stabilize, higher ratio in 30-35 range, lower ratio in 50-25 range, depending on the industry. So I assumed about 32. It could be 32 to 35 range. My high price forecast is about 440, and low price is this is slightly conservative, but I looked at the last 52 weeks price. Last 52 weeks is about 194 or so. I picked 20 because companies, these current products are being established. And income will be, PE will be lower. So I chose 20, and low price is 206. And with this, the assumptions, the stock is in the buy range, and upside downside potential is 6.9. You can see that it's well within the buy range, and this is a good time because October drop, they dropped one drug. It's giving a buying opportunity. I wanted to make some comments on how to adjust, and I'll show you in the next slide. But on this SSG, I adjusted. There is a one-time EPS is adjusted. Instead of $8, it's a $2.06 because there is a one-time adjustments of $6. And Q3, not only yearly adjustment, but we had to do the Q3, the latest quarters also. I adjusted this one. I will show you on the value line sheet next slide. But then income tax rates for this is note 2002 2017 with the negative earnings are made zero in the annual data because annual data shows negative input. It's coming from Star and the Morningstar. And value line 5-year estimate in the revenue and EPS added in 2024. This is the data point I added under the detailed estimates. That's why you see those bullets. PE for 2018 is discounted with no meaningful data. These are the notes entered on the SSG. And these are the locations that we had to look for. This is the 10-year data for non-GAAP adjusted SSG and the annual. And this is quarterly data. I use it. And the next one is on the bottom line. You can see that a major adjustment is 2018 $6 one-time tax benefit because all the prior years they have lost, and this one is they got the credit for $6.03. The way to deduct that, and then the graphs and SSG analysis makes sense. Okay, what's the great about the company? I looked at some analysts. This cutout is taken from I think E-Trade. You can see that the stock is a buy, and buy, and 4-star outperform buy. And the reason is the previous quarter drop and a good price. The company is solid industry, and it is diversifying quite a bit in the future drug research. Stock dropped to 21%, and I just mentioned that its CF drugs are so strong. There's no competition. There is no possibility of generics for several years. The only breakthrough can come through gene editing drugs, which some companies are performing, but this company is also performing gene editing research in the future for cystic fibrosis as well as other areas. Revenue and EPS surged estimates, guidance is up, and revenue is very strong and EPS is very strong last 3-4 years. Consistent and above average growth last 5 years, 48.3%. Cash balance right now is $6 billion to support its R&D. It's a heavy R&D expenses. It has positive free cash flow for 4 years, and the pandemic did not slow this company. And I did not mention that, but their debt ratio is very low, 8% or 10%. I think that's my last slide.
Thank you, Eddie. Jane, can I make you presenter?
Sure.
Okay.
So basically, this company just started making money recently.
Yeah, can you repeat why those EPS were crossed off? And I didn't catch that.
They were negative. They did not make money. So I don't know why he crossed them off. I guess that will make the earnings much higher
Mm-hmm.
because those are negative numbers, skew all the
Yeah.
data. I
There's,
assume.
that there's a logarithmic scale that's being used when they do the chart, so that's why he crossed it off. Okay,
Okay.
thanks, Jane. It's all yours.
Great. Yes, thank you, Joanne. Okay, I think the two companies, Adam and Riley, presented, they are all very quality companies. And I particularly like to introduce you BioMarine, just because it's a company that is very unique in this biotechnology sector. And this company is expected to have a profit for GAAP purposes this year, meaning 2020, last year. And also, this company has achieved positive cash flow for the past 3 years, since 2018. And for non-GAAP purpose, it has achieved profitability since 2017, 3 years ago. So I think in order to achieve our return goal, our club as a whole, we should consider some quality speculated plays like BioMarine. And this is the company I want to introduce you today. So as I mentioned, BioMarine is in the biotechnology sector. It's a medium-sized global company. And it develops and commercializes innovative therapies for people with serious and life-threatening diseases. And especially it's a pioneer in enzyme therapies for patients with PKU condition and MPS conditions. And what's PKU? PKU basically is for people who have missing enzyme, PAH. Because of the missing enzyme, the body cannot digest or metabolize PHE acid. So that results in severe intellectual disability and some psychiatric symptoms. So that is a very serious situation. And MPS basically, again, is missing enzymes. It can be more than one enzyme. And because of that, the body cannot break down the long chains of sugars, and which will accumulate in the cells and tissues, affecting bones, skeleton structure, connective tissues and organs, and resulting in dwarfism, in large organs, joint stiffness. So this is another situation with people with that kind of condition. And another candidate for their development, their product candidate is inherited bleeding disorder. And this hemophilia A, it's a disorder that in a person, if that person have an injury, then you would bleed, excessively. And because of that, the bleeding can go into joints and muscles and brains or organs, not only causing pain, but will also cause a lot of complication. So basically, BioMarine is a pioneer to treat dwarfism, PKU, and all these conditions. And BioMarine enjoys life-saving, enjoys lucrative monopolies in several rare diseases, as we see earlier. And even though these life-saving therapies may save only a a few thousand patients globally, but which each therapy carries a very high price tag, usually a six-figure price tag. So also this particular symptom that I introduced earlier have high barriers to entry. So that's why it enjoys a monopolies in certain way, and also it does have a moat, even though it's it's narrow, but this moat extends well beyond patents, because enzymes to treat all these rare diseases are very difficult to manufacture reliably. And its drugs and therapies hover well below blockbuster status, making them less profitable targets for generic firms to compete. So they have all these approved drugs, and as you can see, basically is for dwarfism. And even though these drugs, these first two, have just expired last year, but then it still enjoys solid growth in emerging markets like Brazil, and also because as you know, some of the children, when they are diagnosed with dwarfism at a young age, and then they will see that when they keep on growing to adult or young adults, then they need higher doses for all this treatment. So because of that, then it's continued to grow very, very well. And Kuon is the only drug that really facing competition, because again, patent expired last year. But then this company is very, very good at research and development, keep on coming up with new drugs like Panizid. This is a drug that treats adult patients with PKU condition, and also for young patients with severe PKU condition. So this is a drug that kind of replaced Kuvan, and it really treats the patients with the PKU condition all across the board. And these patents will not expire until 2030 in USA. And another drug they have being approved is Vimizim.
Oh, Jane,
and this
Jane?
is yes.
Jane, what is PKU? Pardon me,
PKU
I don't know,
is
but what's PKU?
I have explained earlier. PKU is somebody who has a missing enzyme PAH, and then will accumulate, the body will accumulate PHE acid. So when you have that acid in your blood, then it becomes toxic to your brain, and you will have severe.
Well, it's called phenylketonuria, and
Thank
they
you.
can't break down phenylalanine, which is an amino acid which is in proteins. There's diets that people can eat special foods, and they can eat bananas, but you know, regular foods give them a problem because they can't break down a particular component of protein.
Yeah, thank you so much, Tom. You are exactly right. So the PHE acid is normally from protein containing food. So they basically cannot touch those protein containing food. And so it's very restricted, and it causes a lot of hassle to their lifestyle. Okay, so, and Vimizim is another drug that is treating the dwarfism. And again, they have a patent currently valid. And another drug they have is Prenero, and this is for severe neurodegenerative disease. And this kind of disease will result in impaired vision, speech development, and also intellectual and developmental regression. And that has been approved in 2017 and will run until 2029, 2027. So this chart that just show you all the drugs they have approved, and some of them have expired recently. But however, as I mentioned, even for those patents they have expired, they still enjoy the high growth in their sales, because of the reason that they are the one or you know almost one or the only that is treating all these conditions. and and also they have high growth in their in emerging markets like Brazil and the other companies in the other countries. And
So
also
you're
not
saying,
only
sorry, Jane, when you
sure.
say patent expired, but there's only company that makes that type of drug for that disease. So you are saying also implied that not necessary to have a patent because there's no competition. So what does that mean
Actually,
when patent expires?
no, actually, when patent expire, then generic company will come in, right, to
Okay.
manufacture. Yeah. So because of the fact that the process to manufacture these therapies is relatively difficult, and they are the pioneer in enzyme treatment. So because of the difficulty, then the cost of enter this sector is high. So that deter the generic company to come into this sector and compete with them. Does it make sense?
Yes. Thank
Okay.
you.
And they not only pioneer enzyme therapies, they are also doing gene therapy, and they have been investing a lot in their gene therapy manufacturing facilities, and also so they have increased the manufacturing capacity for these gene therapies. And also there's the risk I can see in this pandemic situation is that these treatments normally are conducted in clinics or hospitals. So because of the pandemic, some of the treatments may be mixed, and some treatments started for new patients may be delayed. So that's one risk I see. And not only with so many drugs, they have been approved, and they also continue their research and development, and they have quite a few in their pipeline. So the products in development include all this. And I will not go into detail because you can see them on the screen. And some of them are in clinical phase 1 or 2, and some of them like vasoritide, this one, vasoritide. This treats patients with dwarfism. And this is a kind of dwarfism that is very common, and it's short-lived dwarfism. And this drug particularly will treat kids with this condition, and they have a potential to restore normal growth rate if they get treated timely. And this is expected to be approved in the second half of this year. And another very potential product is Roctavian, and this is another gene therapy for severe bleeding condition. Remember, I just introduced, and this is a key catalyst for this year. And actually, last year it should have been approved. It was expected last year, second half of last year, but the FDA, after they issued 4-year successful data, the FDA for some reason recommended in August 2020 that they need additional 2 years of data to show that the bleeding, to show that the highlight the annualized bleeding rate of the patient population. So they need that. So because of that, the launch in the USA is delayed until middle, possibly middle of 2022. So this is a guidance that is being provided in the last year third quarter earning release, and it shows that 2020 will have a slightly lower sales figure because of the delay of this drug we just mentioned, Roctavian. But however, it's not actually that much adjustment, it's just very slightly lower. And also because of the a slightly reduce in the Vimizim drug. But with that, the R&D research, as you can see, that is about 35%. So basically, they adjusted for the approval delay in that drug that we mentioned. And so even though the sales figure has being lower, and but the sales continue to grow 11% to 18%. And this is from the value line. Value line shows 11 to 13% in sales growth. Morningstar shows 18%. Goldman Sachs shows 18%. So it's healthy. It's healthy revenue streams together with the management is quite controlling the cost. And so this year, actually not this year, last year, 2020, this past year, this company should realize its first full year of profitability for GAAP purpose. And as I mentioned earlier in the beginning, this company has achieved positive cash flow for the past 3 years since 2018. And also for non-GAAP purpose, it has achieved profitable position in 2017. And this chain is expected to continue for the future. And basically the adjustment to GAAP net income to come back to arrive at non-GAAP income is we take a deduction for the income taxes, any benefit from income tax, and we add back the stock-based compensation expenses because this is not real expenses. And also we add back the expenses to the product candidates that they have not got approval for, but they do have expenses, so they, for matching purpose, they add it back.
Jane, you have a couple more minutes.
So, oh, sorry. So the cash asset, as you can see in the value line, cash asset, yeah, that is for the end of third quarter last year, it has increased from last year, I mean 2019 to 1.5 billion. And also this company, as I mentioned, it has achieved cash flow, positive cash flow since 2018, and the earnings for this year, it will be the first year of earning, and it will continue to grow. And the debt level of this company is about 20%, which is quite reasonable considered for a biotechnology company. And value line, even though the financial strength on value line is B because it's being in a loss position, however, it's, as you can see, it's quite, the capital appreciation potential over this next 3 to 5 years is quite handsome. And it's my experience that when you when we purchase a biotechnology company in this early stage, sorry, that's my alarm. Okay, the potential for return is quite substantial, and I have experienced, as I mentioned before, that when you buy at this juncture when the price is right, then the return could be like more than 100% easily. So for valuation, approval of that particular drug, Roctavian, because of that delay, then the share price plummeted more than 35% in August last year. And it was 119, they dropped to 77, and since then it has come back to 82 last Friday. So before the pandemic, the price actually on March 4 has 20 has reached $96, $97. So it dropped to 68 because of the pandemic. And on July 21, it has peaked at $131, $32. So current share price has been bouncing between 76 and 89. So 2021, as you can see, it will be a very important year, data-rich year for BioMarin, because the price will be affected by how the products in development will evolve, and that will certainly affect the share price. And normally I will not show the target price for different analysts, but because this is a speculative play, and I want to show you what the market think of this company. And as you can see, for the forecast period is like, about 12 months to 18 months, and value line is looking at 98, Morningstar at 101, and Yahoo is 108, and Goldman Sachs is even crazier, it's $188. So currently the price is $82, and the potential upside is 49% based on the market. So PKU is one of the world's most common metabolic disorders, and BioMarin is well positioned to treat the entire spectrum of patients with PKU condition. And it has enjoyed lucrative monopolies in several rare disease niches, as we mentioned earlier. And for the first year profitable year will be, for GAAP purpose, will be 2020 this past year. And going forward, it continued to be profitable, possibly affected by pandemic, but I believe this trend will continue. And the non-GAAP profitability has since 2017, and the positive cash flow has been since 2018. And there's an attractive estimated upside. And according to our club policy, we can allocate 15% of our fund to speculative plays. Currently, we don't have speculative plays like this, so I recommend purchasing shares of BioMarin. And any question you may have concerning these three companies? That concludes my presentation. Sorry.
So Mike, the person showed us how to look the P's, the business cycle. I tried, but I have no success. I don't remember what indicator to choose. Tom, do you know how to use big charts? To compare the P's?
I do.
Yes, I know how I can pull it up here. The one that Mike was recommending.
Yeah. Okay.
Okay. What stock do you want?
The three companies that they
Well, which do you want first? Well, we'll do Vertex.
What's the first
Regeneron.
one?
Regeneron.
REGN, I think.
Okay, we'll do.
Yep.
So up the indicator is showing earnings. Oh, okay. Low indicator P ratio. Okay. Rolling EPS.
Okay, so he recommends 5 years.
5 years. Okay. Frequency.
So
okay, frequency we choose daily. Okay, and up
okay,
indicator showing earnings.
So the PE ratio isn't cycling. It's going. It's
kind of.
It's lower than it has been in the past, but it isn't. Here's the share price. And I guess the PE ratio, it has been so high in the past. It's kind of hard to see here because the scale is so large.
So how do you overlap? How do you overlap where he was showing the PE ratio overlap with the?
With what?
Well, he put in like a high and a low, where the PE goes up and down, but this one doesn't really cycle like that. This one over the last 5 years, it's just
actually going down, sort of.
It's been kind of a well, but it started out at 100, so I guess that's what you'd expect. As they become profitable. But
you can see the earnings going up. Right?
But this doesn't really fit the model.
What's the time frame?
The earnings.
5 years.
We're looking at 5 years.
But isn't that supposed to tell you that this is when it's going down, it's a good time to buy potentially?
Well, potentially.
Well, I think that's what was the question: where to sell, where to buy, right?
Like in the last 1 year. It got down to I guess it dropped now I don't now is this the stock that we did
Yep.
the big adjustments on
No, that
or
was
not?
Vertex.
No.
That was Vertex.
That was Vertex. Okay. So well, the PE did, it did drop dramatically here, I guess, in the middle of the year. But I guess that was when the earnings went up.
Yeah.
There was, there's more enthusiasm, when they're thinking about more, more market for the COVID. So, I don't know. This doesn't really fit the model where it's cycling back and forth, but it isn't at a super high PE.
Do you want to check the other stocks, Tom?
Sure.
The Vertex.
Should we use a compare to, or should we just do one at a time?
Well, that's I don't
Okay.
I don't know how to do that.
See, they're there. Under daily, it says compare to. Okay.
Well, I think that's for the compare. I think is for indicators. I don't think you can compare to other stocks.
Okay, I see. Okay.
So so now this one, again, the P's been so high in the past. Let's try like a 1 year here. So the PE on this one is, been fairly low here. It did drop down substantially when they had that, when they discontinued that clinical trial. So, this is certainly a better buying opportunity than it was a few months ago, but, nothing's guaranteed. And I don't think that BioMarin has any earnings, so that'd be a little tough. Yeah, so the PE ratio's
Zero.
negative 0.5 up to 0. So, but they're showing earnings. That's weird. So I don't know. Earnings per share of 4. Well, I don't know. Maybe they haven't. Well, that's just a couple months, maybe. Maybe it isn't long enough to show up. So that's these particular stocks aren't really following his model. I mean, like
His model is the business cycle.
Yeah, following that business cycle. I don't know if we have. Well, let's try Facebook just for the fun of it.
I think would be good if we would use the stock comparison guide with the 3 or 4 stocks we're trying to look at. Just use the comparison guide to see which one we like.
Well, we're about out of time.
Got approval.
Did you guys do it? Jane, did you guys do a comparison guide?
We did one, but it was not with the current SSGs. And plus, BioMarin doesn't have any earnings, so we couldn't do it.
What about other 2 companies? Did you guys do it? Well, do you have SSG in your? Do you have a both SSG in your SSG?
I did one. Okay, here.
Do you have a latest SSG? If you do, it's quickly.
Let me see. I have.
And maybe, meantime, if you let me share the screen, I will answer Hani's question about the stock repurchase plan for REGN.
Okay, I'm making you.
Yeah. So as I mentioned, they talk about this 100 million repurchase in, I guess, last September quarter. If you take that value, that price that they paid for those shares was about 558. Yet, if you look at the 9 months, the average comes to 415 per share. compared to, I guess, 518 that it's now. That's just to address the question there. Thank you.
So what does that mean?
Thank you.
They bought back at a higher price.
Okay, now we're at the end of our time, aren't we? So do we need
Yes.
to move on here to making some decisions?
Yeah.
What was the suggestion about that we vote on it the next time? No, or a week? Give ourselves a week to go over it. Did somebody mention that or propose that?
I did.
Rather, oh, you did, Megumi, rather than trying to rush through a
Rush,
decision
Yeah.
at the end of the meeting. Do we want to have like a 3 days?
I'd like
4
to make
days?
a motion that we take a week to think about it. Maybe do as Bernard suggested, the stock comparison guide,
Mm-hmm.
the 3 companies, and then we can do a vote by email. And
Okay.
if today is Monday, I can send out a ballot, a voting ballot next Monday, and give people a week to review this.
Okay.
So as a committee, were you recommending purchasing all 3, or did you pick the best one out of the 3, or?
Oh, we didn't say which one to pick.
We're waiting for see the stock comparison, and then somebody needs to make a motion.
I think they're all.
So Jay, I just made a motion.
And I
You made a
seconded it.
motion to wait a week.
To
You
wait
did not make
1
a
week.
motion to
Right.
for a specific stock. That
Right.
Correct.
Megumi is asking.
Okay, so
Well,
are we going to vote on the motion in iClub?
I'll second it.
There's discussion. So
I second Haney's motion. Oh, I second Haney's motion.
okay, any discussion?
I think it's a good idea.
I think it's a good idea to have comparison for 2 companies, but for BioMarine, it's a speculative play. I don't think you can compare because there's no earnings, positive GAAP earning in the previous year. So either you look at this company and look at the quality and look at the products they already got approval for and the products in development and decide based on that and look at the pricing.
And we also, didn't we decide that a certain percentage of our portfolio could be in speculative stocks?
10%,
Yeah.
I think.
Do we have any in there now? Do any of our?
There's only one. Oh
Yeah,
wait, do you consider IPR speculative?
No.
If they have
Okay.
earning track record, I don't consider
Okay, so
it.
then we don't have any.
Okay.
Okay.
I move that we buy BioMarin.
Bernard, we
Oh.
just discussed that we're going to wait for a week.
What now?
We're not going to.
Yes.
That's the other 2. Oh well.
So just to clarify, if we all wait, when we wait a week, are we sending a ballot then for all stocks that are presented? We all vote yay or nay on those ones. So we don't need to do a specific motion any particular company that was presented, or are we going to have to also do a motion to specify the company?
I think after a week, if people want to make a motion on individual stocks, they should do that. Then based on that, we'll send out a voting.
So do we want to have the general review done for next Monday, and then that's when we make motions, or should we do the voting by Monday?
Seems like we should do the voting right at the beginning of the meeting. Everyone's
Wait.
done their.
Oh, you want to wait
research
a
and
month?
then-
You want to wait a
No,
month?
a week, and then you just vote at the meeting, like right away.
What meeting?
We can have our. Oh, it's a month. That's right. Oh, never
Like
mind.
my question is, are we doing our analysis and our comparison by, for example, Friday, and then we make motions to either buy any of the companies that were presented, and then by Monday we have our votes in, or do we want to have a review done by Monday and vote same day?
Well, the way that it should go is somebody makes a motion, somebody seconds it, then it should be open for discussion, and then you
Right.
should vote.
I know,
So how
but
do we
his
open-
question was my question. Are we voting all three companies after
No,
our review,
no.
or are we? Somebody's going to make a motion for
Somebody
particular
has to make
stock?
a motion to
Okay.
purchase a stock.
And so we'll do those motions now then as well. So we only compare the companies that are up for vote. Is that how we'll
Well,
do
how
it?
can
The
you make a
motion
motion?
right now is, yeah. Go
How
ahead,
can you
Joy.
make a motion to buy a stock if you haven't reviewed
So
it?
right. So that's my question, right? So if we're doing
Yeah.
a week to assess,
Well, how
how do
long
we
will it take to
motion?
prepare this comparison guide?
Right.
Everybody should do their own. All the ITKs
Who's
are,
going to do it?
you do your own.
Whoever's
Oh.
interested in
If you want,
recommending.
if you would like
I think,
to,
yeah, I think we need like a time frame that we're going to make
Right.
motions and vote.
I think Friday for motions, maybe Saturday for discussion and Sunday to vote. Because the
So then,
discussion will have to be by email, right?
Right.
Mm-hmm.
And then we
one
would make
day
a purchase on Monday.
Okay, I would like to also propose that we think about adding to Facebook. You know, we don't need to make the decision right now. You know, the price is favorable, but the you know, they've got political and with regulatory risk, you know, kind of hanging over them. So that's a possibility. But you know, they could go lower. And also, I'm wondering if we can sell Franco Nevada and CyberArk because nobody owns them.
Yes. I was
I
going to make
second.
this.
Sorry, I
I
own
second.
Franco Nevada.
Oh,
Oh, then we sell CYBR. I second.
What? What was that?
Okay, so I think we should hold all of our motions
Right.
to that Friday,
Yeah.
right? So we
Yeah.
do motions on Friday, discussion on Saturday, vote on Sunday.
I think, but I mean, not to put words in Tom's mouth, but I think his point is that maybe we want to make a decision on Facebook before inauguration and the change of the administration. If there's any regulatory changes, did I understand that correctly?
Well,
the
yeah,
Facebook report is due next month. Can we
Mhm.
can we wait
sure.
for our own
But that's
individual
not answering Mina's question. Mina was saying, do we want to make a decision before January, the change in administration?
21st? What's
The
the
20th.
rush?
What change in administration? Our
Biden
country?
is the inauguration.
New
So what's the
president.
rush? Why do we make
Yeah.
investment decision a rush decision? You know, we know based on what Mike's presentation, we know that it's a good candidate to add more to it, right? So
Mhm.
things,
Yeah.
Megumi is going to give a earnings quarterly report. Why do we just wait till February?
Perfect.
Does anybody have an issue with that?
No.
No,
Okay,
no,
let's
it's
wait till-
fine.
Okay.
Another
Oh.
thing is I put the agenda right here. Remember last time we talked about peer review because there's so many reports we cannot review them all. So we
Right.
decided each one has a peer review. So Facebook, Jane's peer reviewer, Comcast, there's no peer reviewer. Who wants to review Comcast?
Yeah, you have to, everybody has to pick one.
I'll do
Not to
Comcast.
review.
Okay. What about okay, IIPR is Joanne, Inogen is Megumi, Qualis is me, CYBR we have nobody. So I guess we could sell them. Frank Nevada, we also need a peer reviewer as well. Oh, sorry.
Okay.
Who wants peer review Frank Nevada?
Does Christopher
John?
reviewing it? Oh, wait.
Oh yeah,
no,
Christopher
Christopher.
was going to do CYBR. Christopher, can you do Frank
No,
Nevada?
Christopher is doing QLYS.
No, he is a peer
excuse
review
me,
of CYBR.
Jay.
Oh, yeah.
Jay,
Yes.
it's getting a bit late. So can I suggest that we, if we're going to assign peer reviews, maybe just do that by email after the meeting. Let's get to our guests.
Yeah.
And
Yeah.
then,
Are we going to vote on the new members?
Yeah, let's,
Yes.
well, we'll do that after we,
Right, we already filled out just a few of them that please take a look. There are a few companies that no one assigned for peer review. What I having showing right now is just need two more.
Okay.
Frank Nevada and Lamb Research need a peer reviewer.
Okay, I think we should do that
Hanny,
just
we
by
need to
email.
vote
It's
on your
not-
motion. Hanny,
Yeah,
we need to vote on your motion.
I can't seem to log into to my iClub, but I'm in favor of the motion. Sorry, I just don't want to slow anything down.
I sent out the voting.
Yeah, and I'm just having a problem logging in with the link, so I don't want to slow us down any further, but I'll keep trying here.
Okay. All right. So Jay, you'll send out an email regarding the peer reviewing, and
And can you remind just a sentence or two on what that means? I forgot.
Okay.
Like, what does it mean for us to be a peer reviewer for that stock?
Okay.
That would be great. Thank you.
Okay, sure.
okay. And then Friday we'll finish reviewing these new companies, and if someone wants to make a motion to buy, we'll do that on Saturday, we said, and then voting on Sunday. Is that?
Well, no,
Okay.
my motion's on Friday, discussion on Saturday, voting on Sunday.
And vote on Saturday.
Voting Sunday. Yeah.
Yeah.
Okay. All right. Okay, can we stop the recording and get to our panelists?
Okay.